Hello, everyone. Good morning, good afternoon, good evening, depending on where everyone is tuning in from. Thanks for joining us for the second part of this TCFD Task Force on Climate-Related Financial Disclosures training for the financial sector with a sector focus on banks. Today is part two, where we're building on what we learned last week. Yesterday, wasn't so far away. We're looking today at risk management and metrics. And as a reminder, yesterday we were focusing on governance and strategy. So as we get started, I would just like to, if I can change the slide here, perfect, introduce again the team from our joint collaborative group that are here today with you to facilitate this training. So myself, I'm from the UNSSE initiative, and I'm joined with Evan Guy, a policy manager from CDP. We also have with us today Barrett from IFC, who's a senior climate finance specialist, and Leah from UNEP-FI, who is a program officer for their TCFD for Banks program. And in addition to us four who will be talking you through the content today, we're also joined with a number of experts on the call who are going to be answering all your questions, and they'll be busy typing away both in the chat and the Q&A box as you have those questions. So we have with us again today David Carlin from TCFD for Banks program at UNEP-FI, and Aisha Malik from IFC. And also from last program yesterday, we have Ralitza and Maheen as well on the call. So thank you everyone for coming together to provide all this wealth of information you all have with our audience today. So since we have everybody here, please don't hesitate to ask questions as we go. That's what we're here for. So please make use of that Q&A function. If you ask your questions in the Q&A, it does ensure that we don't miss it. If you put it in the chat, sometimes it gets going. We love that you're all interacting and chatting. So please don't hesitate to keep letting us know where you're coming from and share who you are. But if you really want to make sure your question gets answered, please put that in the Q&A box. Also, as a reminder, we try to take about 5 minutes break halfway through. So we'll keep to that this time as well. And all the materials in this presentation are in that handout sheet that you have. So you got emailed through Zoom a link for a handout. Also, my colleagues are putting that in the chat box. They'll do that a number of times. So you can either follow the link or download it directly from the chat box off of Zoom. We will be providing a feedback survey at the end of this session. And if you participated yesterday as well as today, or in one of the sessions yesterday and the second one today, you will be able to get the certificate from CPD in order to show that you participated in those two sessions. Just to let you know that certificate does take a little bit of time. It's CPD that does do the certificate. So once we send off the names to them, they then need up to a month to send that certificate out. So please do hold out a little bit for that certificate, but it will be coming your way. Just to flag, the handout is in the chat box right now, so you can download it there. Somebody also asked in the chat about the recording. So that recording will be coming onto our YouTube channel. I believe the one from last week is up either today or tomorrow. And then in about a week's time, you'll see this week's sessions up as well. So today's agenda, what we're covering today is we're going to do a very quick review from yesterday. For those of you who weren't able to join us, we just want to make sure we get you up to speed in what we covered yesterday. Also, then we're going to deep dive into those climate risks and opportunities specifically for banks. So we introduced climate risks and opportunities yesterday. We went into quite a bit of detail about what they are for all sectors. And today we're going to go into the bank focus and really understand what are those risks and opportunities for climate facing banks. Then we're going to move into managing those climate related risks. And before our break, we'll also introduce metrics and targets. So how to choose the right metrics and set the right targets for climate-related disclosures. Then we'll take a quick 5-minute break. And after the break, we're going to deep dive into net zero targets particularly. And then we'll do a little interactive exercise on transition plans and talk you through what exactly a transition plan is and how you can use that. As with last time, we'll end with a series of resources that you can use to fill your toolbox and continue on this journey, and hopefully have time for a bit of Q&A at the end as well. However, please don't hold your questions for the end. If you do have a question, please answer it as we're going, and we'll make sure we get to all those questions throughout the training. Our learning objectives today are 4. So the first one, we're here to be able to help you identify the practices you can use to manage climate-related financial risks and opportunities that are facing particularly the banking sector. We're also looking to help you understand what measurements are appropriate and effective in measuring and setting targets for climate resilience. The third objective is to help you to understand how a transition plan and net zero targets can be implemented. And then finally, help you to identify how the TCFD recommendations can be used with other key tools and frameworks to create a resilient and agile strategy. So with that, I'm going to dive straight into a review of what we did in part 1, so our last session. What I'd like to do is start off by showing this diagram, which we did show last time, but it's those 4 core pillars that we're covering. So remember last time we looked at governance and strategy, the first 2. And today we're going to look at risk management and metrics. But as a reminder, these 4 pillars should be aligned and interconnected. Even though we talk about them separately, they each build on each other and work together. So it's important to see them as a holistic set of recommendations. Now, we also discussed last time how governance and risk management, the first and the third pillar, are really more process oriented. So we'll get more qualitative disclosures there. And we want to understand those processes that are in place in your organization. So in governance, how is the oversight undertaken, and how is the accountability for that oversight in your organization? We really want to understand specifically, how does climate fit into that oversight and accountability? Now, we talked last time too about how generally when we think of corporate governance, we think of the board level. However, here we're also looking at managing those climate related risks and opportunities. So board and management level at the governance. And then looking further into that risk management, how we're managing those risks and opportunities, we want to again understand those processes that an organization has in place to be able to manage those risks. So here we really want to make sure that you're sharpening your vision and that you see these risks and opportunities that climate hits organizations. So we also mentioned last time that climate is really a non-diversifiable risk. So when it is identified, it should be treated like any other business risk. It is unique in that it hits on very different time horizons than we're used to, and that it is non-diversifiable and it hits all organizations. So that's why we need to add additional processes in to make sure that we've got the right processes and that we're on top of these risks and opportunities. So then that strategy and metrics and targets have what we talked about last time as a materiality lens. So just making sure on strategy and metrics and targets, what we're disclosing particularly is those risks and opportunities that the processes, our governance and our risk management allowed us to identify will have a financial impact on our organization. So that's in the strategy component, we really want to understand what are those risks and opportunities we've identified. What is the impact that they have on our organization, and how are we determining or ensuring our resilience as an organization vis-a-vis these risks and opportunities? And then, of course, the metrics and targets, which we'll talk about more today, is helping us understand how we're measuring, how we're doing our progress on that and where we're aiming for. And they should always align with the strategy. So with that quick review, let's think back to that scenario analysis that we did last time. I'm just going to get this one up here. Oh, sorry, this one's about transition risk. So what elements of a climate scenario are relevant when exploring transition risks? So remember last time we talked about transition risks and physical risks, and we can use scenario analysis to evaluate both of those. So if we're looking particularly at a transition risk, which of these would we be looking at? Carbon prices, sectoral emissions, sea level rise, and economic indicators such as GDP. So I'm going to give you just a moment to fill that in and see who remembers what we discussed last time. Okay, well, everybody's doing very well. I'll give you maybe 10 more seconds to fill it in. I see everybody's filling in quickly. Yeah, and some people have noted in the chat, if you're having trouble accessing the polls, that's no problem. We only have 2 polls today. So feel free to just drop in the chat your answer. If you're not able to answer in the poll, that's fine. Okay, well done, everyone. I'm gonna go ahead and share this one here. Okay, bravo. Everyone's done very well. You have identified the one that is not a transition risk. So sea level rises is indeed a physical risk. So the other 3, carbon prices, sectoral emissions, and economic indicators, are all indeed elements of climate scenarios that are relevant when exploring a transition risk. So well done, everyone. Now, when we're looking at climate-related financial disclosures in alignment with TCFD, there were a few key things we wanted to highlight last time, and I just wanted to review briefly this time as well. First is, where should they be reported? We said this quite a few times last time, but as a reminder, the task force does indeed recommend that organizations provide this information in their mainstream public annual financial filings. So as we discussed last time, the objective is not to create a separate TCFD report or a separate climate report, but rather to use a materiality assessment and to understand the financial impact of these risks and opportunities in order to pull this into our annual report. So how do we get that information into our annual report? Well, the task force isn't prescriptive on exactly where it should appear, but rather on what information should appear. So what the TCFD helps you do is identify those risks and opportunities, making sure that you have the right governance, the right risk management in order to be able to identify these, and then lets you know what information investors need. Equally, as an investor in other companies, the TCFD helps you to identify what information you need to assess the resilience of the companies that you're investing in. So what information is material? We also highlighted last time that there's certain pillars or elements of the TCFD that all companies should be disclosing. So governance and risk management, as I said, are those processes behind the scenes, what we need to make sure are in place in order to identify these risks and appropriately manage these risks and these opportunities. So both governance and risk management disclosures are deemed by the TCFD to be material for all organizations. So all organizations can start with that, should be disclosing their governance and their risk management and how climate is integrated into that. Then when we're dealing with strategy and metrics and targets, there we should apply a materiality assessment and identify which risks and opportunities have that financial impact, and then be providing information on basically how you're managing those risks and opportunities, and what impact they might have, and what is your strategy to deal with them. So when we talk about financial impact, this is what we mean. So particularly when we talk about financial impact, we can see this as hitting our financial position or our financial performance. And with our financial performance, it will fall here in our income statement, in our cash flow statement, or our balance sheet. So understanding if these particular transition risks, physical risks, or opportunities are hitting our revenues, our expenditures, our assets and liabilities, and our capital and financing. It's also important, of course, to look at how this would impact our portfolios and the weighting in our portfolios. But What it needs to come back to is that financial impact. It's also important that we can find this information. So just to highlight that a TCFD mapping and reference table is increasingly being used. However, not only is it useful for the report users, but also for the report preparers. And as a bank, you might also want to encourage your clients to start using such a tool so that it's not only easy for you to find this information in their disclosure, but it also for the report preparer indicates where there might be a bit of a gap in their disclosure. So I just give an example here of what I mean by a TCFD reference table or a map. It's very simply just the 4 core pillars of the TCFD: governance, strategy, risk management, metrics, and targets, and then the 11 recommended disclosures. So under governance, there's 2, and under the other 3, there's 3 recommended disclosures. And then indicating where this information can be found. If you're a very advanced company that's already fully aligned with the TCFD's recommended disclosures, you will find all of this in your annual report, and you can indicate where in your annual report, what page number, what section. But companies that are just getting started will have maybe a couple of these in their annual report, but then they might have another few in other reports or additional information that's not material to them in other reports. So you can indicate that here. You can also use this to start identifying that roadmap, how you plan on moving forward. And so 5 tips before we move on into the specifics of our second 2 pillars today. So this is adapted from A4S Accounting for Sustainability, and it was top tips for finance teams with TCFD. And the first tip is one we talked about last time, is really identifying where you are now. So this includes often doing a gap analysis or roadmap. We showed a roadmap in yesterday's presentation, so you can see that in the handout from yesterday as well. But often this stage involves really identifying what disclosures you already have. Maybe you already have your greenhouse gas scope 1 and 2 that you're accounting for, that you can start pulling into your disclosures. It's where you want to identify the key risks and opportunities facing your organization, and where you want to start thinking about updating your climate policy, or even creating a climate policy. The second key tip is really to get that internal buy-in. We talked last time how important it is to get that tone from the top, or that buy-in from the top. We also recommended a TCFD team, where you might want to have a climate champion in your organization. So here what we want to do is we want to really hone in on that financial impact, because that's what gets the buy-in. Your leadership and your board really need to understand what is this financial impact that they're going to see. And they need to be able to then translate that financial impact into their strategic decision-making. So a lot of the processes here we want to see is upskilling of your leadership and of your board, bringing in external experts so that they can help you identify that financial impact or the risks and opportunities. And also introducing accountability and incentives. So maybe something to do with remuneration here. I'm going to skip 3 and go to 4, because I think the third tip is actually a good tip to end on. But the 4th tip here is to collaborate. Now, we talked last time about that TCFD team, and we said it's a whole of organization process, TCFD. So we want to really see kind of cross-functional teams, particularly when you think of disclosure. Here, we want to make sure that everybody that's involved in the writing of a TCFD report is understanding how these climate-related risks and opportunities impact their particular area of that report. So making sure that it's cross-functional, that you have a climate champion, and that you have active engagement with your clients if you're a bank. Then the 5th tip is to learn from others. So we've been seeing a lot of trends, such as that TCFD map or the reference table that I showed previously. Companies have started doing that everywhere, and it's not necessarily in the TCFD's recommendations, but companies are learning from each other, and they're learning from what their peers are doing. You can find out what your peers are doing through the TCFD Knowledge Hub. On the TCFD Hub, you can find a report database where you can search by sector or industry and by geography and find out exactly what other organizations in your industry are doing, and you can learn from them that way. You can also learn from them through a number of case studies that are on the TCFD Knowledge Hub. And of course, joining trainings like this one. And then I'm going to come back to get started. It's a great tip. It's one we always introduce because TCFD is a journey. You're not going to have all the disclosures ready in your first year. TCFD is about getting that capacity built up, shifting your processes to ensure that you're resilient. A lot of people look at TCFD like it's maybe a tick box exercise or another standard you have to meet, and it's all about the disclosure. Of course, TCFD is about disclosure. Investors are asking for this information. However, what it's really about underneath it all is ensuring the resilience of your organization. So in order to make sure that your organization is prepared and going to maintain its financial stability and financial resilience moving forward as policy is changing, as energy prices are changing, as the climate is changing, as our environment around us is changing, then you need to make sure that you have those processes in place. So really the first step is just getting started, and you will build capacity up as you go, and it'll get fully integrated into your organization. So before we end this section, I just wanted to do one more quiz with you all, making sure this is really clear because it's really important. So disclosure of material or financially relevant climate-related data should appear where? In the annual financial report package for investors, in the sustainability report or climate report, on your website, or in other internal documents. And I'll give you just a moment to fill that one in there. I'm happy to say you're all doing very well. Okay, I'll give you another 10 seconds. Great. I'm going to close out the poll now, but if you didn't get to join the poll, I'm sure you were probably correct. Most of you were. So 70% of you answered correct, the annual financial report package for investors. This is because, as we mentioned last time, if we want to make that connection between climate and finance, that information needs to appear in the same report. By including this information in your sustainability report or climate report, that can be used as a tool to enhance your disclosure or to enhance your communication and show your commitment to this. However, it should also appear in your annual financial report package. On your website or in internal documents can be a strategic decision for you, but again, should not be the only place it appears. No investor is going to see it if it's in your internal documents, and it's very hard for investors to find it if it's just on your website. So well done, everyone. Congratulations. It looks like everybody's up to speed. And with that, I'm going to pass over to my colleague, Leah, who's going to go over the climate-related risks and opportunities for banks. Over to you, Leah.
Perfect. Thanks a lot, Tiffany. So hi, everyone. Also a quick intro from my side. I'm Leah. I'm part of the climate team of UNIBEP-I. And with that, I'm working on the TCFD and climate risk program here. You see also my colleagues, Maheen and David in the background. They are supporting me here in answering all your questions in the chat and also in the Q&A section. I will go through a few sections today, and I'm starting with the climate risk and opportunities for banks. And I think, as well as we heard yesterday, and it was mentioned, the circumstances we are currently in and that we are currently facing due to climate risk may give us really some business opportunities, which are maybe the biggest of this decade. And this is kind of important to remember. As wherever risk occurs, we always have opportunities. And this is why I just want to highlight that we need to keep it in balance. And this is also then in line with the TCFD, as you know, as you're aware, the TCFD is not only focusing on the risk, but equally on the opportunities that institutions should look at and also disclose. So with that, I would say let's kick off. So this overview is from the NGFS. And as we heard yesterday, NGFS meets the Network for Greening the Financial System. So which it really illustrates that the climate risk could affect the economy and the financial system through a really range of different transmissions channels. So on the left side, which you can see if we look now into the green part, we have the climate risk really split into the transition and physical risk. And in the middle of this page, you can see the different transmissions channels. They are mostly clustered into micro and macro levels. While on the right side, when you quickly look into the blue box, you can see how they actually can lead to financial risk. So for example, if we are taking transition risk, they can affect business profitability, they can impact households' wealth, and which really can create financial risk for lenders and investors. With that, those risks can actually lead to different shocks in the market and to also the broader economy through investment challenges. Obviously, if the households doesn't get any more the required money, it can also have an effect on the productivity. And a massive threat is always when the transition leads to stranded assets. Then on the other side, we also have the effects of physical risks, so which we can either split into the acute impacts from extreme weather events that really can lead to business disruptions and also damages to the properties where the firms are actually operating on. So these events can really increase underwriting risk for insurers, possibly leading even to lower insurance coverage in certain regions where obviously these weather events are really extreme. And the second level of physical risk is really the chronic impact. And these are really particular from increased temperatures or what we also saw before in the poll is sea level rise. And prediction that may affect can be the labor, the capital, the land itself, and really the natural capital in specific areas. So these changes will obviously require significant investment and adaptation from companies, households, and governments to really try to stabilize the environment we are currently in. And if you look into the bottom of this page, and I know it might be small, but again, we can reference to the handout where you can see the slides or later when you can open them, there is a little feedback cycle. And this really means that financial impacts can have economic impacts. And likewise, the economic impacts can actually create new other transition risks at the same time. So also please feel free, we want to have it as interactive as possible today to comment maybe in a chat box somewhere where you can see where you are impacted with your organization or any questions you might have, you can also raise it in the question Q&A box. So with that, I'm coming to the next slide. So beyond the question, what we're always getting asked, what are the risks they occur? How do they actually do the financial risk, which we looked into? We very often get asked, how do you measure those risks? And where should the company start to focus on, or even to make a prioritization based on the right industry, the right sector, or even the right portfolios? And as we know, it is super diverse. And this is why we have this slide here today. That is as a result of the banking program, the TCFD banking program we were running a few years in phase 3, which was really designed with the members at that time to help financial institutions expand their toolkit for climate risk assessment and disclosures. So every sector we know brings us different challenges and obstacles within a green transition. And because obviously we all know that the bank's portfolios are so diverse, particularly here, 8 sectors were selected to enable really the broader review of all the banks. So everyone felt their interests are represented. And the ratings within the heat map reflect basically the level of risk that participants believed at that time would likely occur under an ambitious scenario. So it means that, the world would represent a major departure from the present economy and would really put significant pressure on a variety of sectors. And also here to mention, an ambitious transition is really always a transition that is necessary to limit the global warming below 2 degrees, which is obviously in line with the Paris Agreement. And as a result, the 1.5 scenarios are the most which are aligned obviously with this heat map. And this heat map actually allows evaluating the disclosure and really managing the transition risk over all different sectors. And we linked all the sources for all our presentation and slides. So this is just a snapshot of it. But what you can see in the report is really a drill down of also the subsectors. So if we take, for example, the agriculture, they looked also into forestry, fishing, aquaculture, livestock, to really start the assessment on a granular level. And then you can actually aggregate it up to a higher level. And a transition heat map was that really allows, or is a valuable tool for all the financial industries for evaluating transition risk across the different portfolios. And if we go to the next slide, as I mentioned before, we are running the risk of stranded asset. And just to mention, a lot of people are always asking, but what are stranded asset and why are they so important to consider? So these are really the assets that have suffered from premature write-downs, so devaluations or really immediate conversions to liabilities. And they are important in that context to remember and to mention, because to limit the warming really to 1.5 degrees, 90% of our fossil fuel reserve must really remain in the ground. So it's really unburnable carbon. And if we look into where they are located, the majority of this carbon is really held by just a few companies. And they are located in just a few global financial centers. And just to put some numbers in, and you can see it here as well on the slide, some 600 billion in US dollars is really concentrated in New York, Moscow, London, and Toronto only, which really centralized the risk of stranded asset in just a few markets. If we're going to the next slide, so as I mentioned, wherever we see challenges, there's also climate finance opportunities on the other side. And that overview was published by the city of Calgary in their climate resilience strategy. And it's a quite nice overview, because if you look onto the left circle, it's really where it's the call to action to reduce the emissions. And climate mitigation finance can really promote the investment in different areas like the renewables and energy efficiency. And on the right side, you can see the adaptation circle, which is really the action to manage the risk of climate impacts. And if we look into the overlapping red middle circle, that is really the part where we are building climate resilience, which means in the future, if we successfully take action on both circles, on the mitigation and on the adaptation side, we might have solution for water conservation, new energy system. We might even produce local food and have some urban forests. Or other examples are really that we can update the education system and complete communities and really in a protective environment and a complete updated infrastructure. So note, these are some opportunities I think which are already familiar. And the TCFD is categorizing some main opportunity areas. And there mentioned resource efficiency, energy source, products and services, as well as market and resilience. So these are the area where TCFD is really highlighting and listing down some opportunities to really give transparency and inspiration to financial institutions. And if we take the example of resource efficiency, there are really a lot of opportunities that can occur. And these can really be, we can have more efficient modes of transport. We can have an updated or a more efficient production system, which allows a different distribution process across the supply chain. We can collect the waste that we are having. We can try to recycle the waste. We can move or build more efficient buildings. And obviously also over time in agriculture, there are a lot of opportunities because we can actually, with the technology we are building, with the investments we are doing, we can reduce the water consumption. And those opportunities, again, if we remember that the first overview, can also lead directly to financial impacts. And they couldn't just be, if we have a more efficient process, we can reduce our operational costs. That means obviously with less cost, we can maybe increase the production capacity because we lean the production. And this can lead to increased revenues. We can maximize the margin. We have bigger profits. And this actually increased the values of fixed assets. So, because we have the support and investment for energy efficient buildings where we are building up the production. And another, I think, very important opportunity and also impact on the financial area is that we as a workforce are benefiting from a better management, a better planning, which obviously can have a direct impact to an improved health, safety, and a better work environment that we all are working. And with that, I really highly recommend you to open the documents, because for each of the different opportunity categories, as TCFD is mentioning, there are just some more details which you really can read up. So I highly recommend everyone to go in. So before I move to the next session, I just want to pause there to give everyone a chance to breathe and maybe ask some questions in the chat to keep all my colleagues busy. Because this is the last slide of the current section. And with the next one, we are already moving to the managing of climate risk. Good. So if we move to the next slide, this is really the transition where we will talk about the third pillar of the TCFD, which, as we heard already in the beginning and also yesterday, this is the risk management part. And pillar 3 is really focusing on how the organization identifies, assess, and manage the climate-related risk. And compared to the other pillars, this is really one which is a more qualitative disclosure, just basically, obviously, due to the nature of the recommendations, but this is just an observation we see. On the next slide, we can see that the risk management pillar contains 3 recommended disclosures. So we have A, B, and C, with 1 supplement guidance under A for banks specifically. And I mean, we are in the session obviously focusing today is on their banks type. And as you are aware from yesterday and also from the TCFD, the task force really organized the financial sectors into 4 major industries. So primarily based on their activities performed. And as I mentioned, we are focusing on banks, which is obviously having their lending activities. And these supplement guidance are really intended to provide additional context for the financial sector while preparing their disclosure. So it is obviously consistent with the general ones, but these are just giving some more add-on details to consider. So the recommendation A is really focusing on the process, how the organization identifies and assesses climate-related risk. So what is required is the TCFD really leans on that a description of their risk management processes should be disclosed. So how does the organization actually determine that it is a relative significant risk for the institution in comparison and always in relation also to other risks? And another point they are highlighting in that A recommendation is that institutions should always consider existing and emerging regulatory requirements that they are taking into consideration, which are related to climate change. And as I mentioned, under A, we have also the first supplement guidance for banks. And this is a recommendation that the traditional banking industry categories, like credit risk, market risk, liquidity, operational risk, should be highlighted. And the context in which climate-related risks are impacting those traditional categories should be really laid out in their disclosure, because these are obviously already the very familiar categories banks are always disclosing. And with that, it is always great if banks also can consider or disclosing any information about their risk classification framework. So mostly there is something already in place, and it is always great for external stakeholders to get the information, what kind of framework have been used and how actually is it established. This is the first section. And if we are moving, and you can see it on the slide, to the recommendation B, B is in comparison more focusing on how the organization is actually managing those risks. And also here is obviously the process should be laid out, but more particular with the focus on how are decisions taken, how are certain mitigations, taken? How are they accepted? How are controls being established, particularly for those climate-related risks? So it already goes in a bit more detail. And as well here, it is required that the organization are disclosing how material are actually the risk that they are facing and the organization might be impacted. In comparison, if we are now looking into the last recommendation, this goes really into the integration into the current overall risk management. So it is really how are the processes integrated into what is already established within the risk management department. So I know it is a lot of theory and a lot of text, but I just want to make clear that the key takeaways are really that this risk management pillar requires to disclose the process on 4 main areas. So it's really how can this risk be first identified, second assessed, third managed, and fourth really integrated into the risk management processes of the organization. The next page is an overview from the TCFD 2022 status report, which was just recently published. You might have seen it. And this is really consistent with your previous status report. So the task force undertook really another review of hundreds of public companies' report for obviously their climate-related financial information and used artificial intelligence technology to identify the current state of disclosure. And this overview is just in a snapshot of pillar 3. But again, here I just want to highlight that you can open the link and also just go into the report as there is another overview where you actually can see how the pillar 3 is disclosed compared to the other pillars, which we heard yesterday as well. And to highlight here on that page, the reporting on risk management processes is really below average, but steadily improving. And you can see it here. If we are looking on that slide, so from 2019, which is the dark blue line, to 2020 was the other color, and then really 2021 is the light blue version, we can see it is increasing over the years. However, I mean, which is also positive due to the low levels across all these 3 recommended disclosures, they have shown obviously one of the strongest growth compared to the other recommended disclosures. So currently you can see it's ranging between 14 to 20 percentage points between the 3 years. And the greatest increase in reporting from 2019 to 2021 is really with 20 percentage points, which is the integration of climate risk into the overall risk management process, which is, as I just mentioned, the recommendation C. And again, these are quite low numbers compared to the other, but I think it's always very important to highlight the positive progress across all of these sections. And if we are moving on, given that the risk management recommendation, obviously in which we just looked in C, is focusing on the integration of climate risk and opportunities into the broader risk management process, it is important also to understand how actually climate fits into the ESG landscape. And I mean, just also as a recap, what ESG stands for, on the first side, we have the environmental pillar. And this is really has to do with an organization's impact on the planet. In the middle, we have social, and this has to do really with the impact an organization has on the people, including the staff, also customers, and the community it operates. On the right side, this is the governance pillar, and this has to do really how an organization is governed and how transparent it is. And I mean, investors are increasingly really applying these non-financial factors as part of their analysis processes to identify their material risk and also growth opportunities in their investment processes. But as I think Tiffany also mentioned it really nicely in our intro, given the far-reaching implications of climate change, there's really an open question whether climate risk action has actually outgrown the ESG mandate and that it needs its own. So some argue obviously for unbundling the climate change from these ESG factors, because just out of nature of the climate risk, it really has impact on any sector. So these elements can directly or even immediately impact the safety of any physical aspect. And this concern is, heightened by the macro nature of climate risk exposure, which, as we heard and as we all know, nearly impacts all markets, all segments, all businesses, either directly or through their customers and supply chain. And I think this is why it seems to be very special and deserves the special attention. And this is, I think, something we also equally see on the regulatory development side. So we do see, and TCFD is also one part of it, that we're getting some regulations which are particularly focusing on the climate-related risk. Good. So with that, in the next few slides, I wanted to highlight some practices we see in the industry, just to give you some practical examples on hand. So this first disclosure example is from HDFC. It is an Indian bank, and this is actually from their sustainability report. So what they have done very nicely is to lay out their anticipated risk, exactly as listed from the TCFD. So it is in the table format. And again, here's just a snapshot from the transition risk. But if you actually open the report, and again, we have linked all the sources here on that side, you can also deep dive into the physical risk section. And with that, you can see that they actually listed legal, technology, market, and reputation as their anticipated risk. And they listed also down how they are actually associated with climate change and how the organization sees the threats and how they want to react on them. And why we also picked this, because HDFC have also a description of how the company identifies those risks and manage them. So they just don't only list the risk simply, but they are giving more details and information for external stakeholders to understand the process that is used to identify these risks. And this is, perfectly in line with the recommended disclosure A, which I just mentioned at the beginning of the section. So, for example, they mentioned how their committees are working and reporting, how their climate risk management is linked to the overall framework. And this is what they really disclosed in that section. And this is, I think, as well nice, because it actually shows us how the different TCFD pillars are interlinked. So because how the governance is represented, because we're hearing about the committees that are involved, who has the responsibilities for certain tasks. We are hearing something from the strategy component, and all those are actually interlinked with the risk management part. And this is what is appearing actually within their slides. If we are having a look into the second example we picked, this is from ABN AMRO, which is a Dutch bank, which have integrated the aspect into their annual report. And they actually, what they did nice is they really applied a sustainable risk policy framework, which is an integrated part of the enterprise risk management. And with that, they obviously immediately fulfilled the two recommendations from the TCFD risk management section, because this is what the TCFD is highlighting. And what you can see here on that slide is that on the one side, we have some bank-wide documents and sector documents. And what they are immediately showing to external stakeholders, they're immediately showing how the business or how they actually define the conditions under which the organization or the bank really does its business, across with their clients, with their suppliers, with their investors, and really ensuring that the sustainability risk is identified, measured, managed, mitigated. So really that there is a process in place that it has to be reported against it. And this is obviously established to keep in line with the bank's risk appetite. And what you can also see here on that slide, one of the bank's white documents are exclusion lists. So an example is immediately that there are some organization sectors on where there is just no way that the organization keeps up their businesses and investments. So I think there is quite nicely done to give the transparency to all the departments and that everyone follows the same line. And I mean, these exclusion is really specify the activities the financial institution is no longer interested in having. And on obviously the bottom, we have also the sector documents. And why sector documents are really important, as I know, we all know each industry is moving so fast and we have very unique characters and considerations to take into account. That is why also here, ABN AMRO really looked into each of the sectors and have some briefing notes for them. And again, this is something we are seeing across different industries, that a lot of briefing papers are coming in how to handle different sectors particular. If we are moving to the next example, and this is maybe the last one I will talk about, this is an example from Banco do Brasil, from their complementary content section, as well from their annual report. So this is a really common way to show prioritization of some topics. And it is important to show, obviously, that all those issues have been evaluated and how. So this is a materiality matrix that you can see here. And what they have been doing, and this is obviously what they are laying out in their report in the continued section, which we don't see on that slide, but still I want to mention that to give you the context. So they have a cycle and like a runoff, and they invited some stakeholders through an online consultation to determine really what are the priority about their sustainable topics, what they are seeing, what are the challenges that also the management is seeing, and what the bank should obviously report against, and what the bank will face over the next year. So the contribution of each of those categories were consulted according to their weight in terms of influence, the impact it can have, also the relevance for the organization. And this is then basically how the management have prioritized those topics, and gave different weights across what I mentioned, the relevance, the impact that it can have, to come up with this materiality metrics. And this is, I think, a great visualization to be transparent in what they identified. So in total, 10 topics were considered as the priority after that analysis, and you can also deep dive in, but the top 4 here are obviously innovation and technology, diversity, sustainable business, and 4 is also quite interesting because it's talent attraction, retention, and development. And what you can see here is, even if it's obviously under the risk management section, it's not only focusing on the risk side, but it's actually looking into different sustainable topics in general. And just being conscious of time, I will skip the other 2 slides and finish basically the part where I showed you some practices. And again, there is no right and wrong. We just wanted to give you some inspiration, what we are currently seeing, and also the TCFD and the Hub has some other best practices on the industry. So please feel free to also look into here. So this is the Climate Risk Landscape Report from UNEP-FI. So we have published it a year ago. And this report can really be used by banks because it highlights actually specific tools that can be used in the industry. And the reports looked into the tools. It actually drilled it down by different attributes. So each of the vendors were compared and analyzed, and UNEP-FI, our team, were looking into different coverages they have of different scenarios, which granularity they are having, and also into the use cases. So which tool can you actually use for your internal purposes? So this really gives transparency for someone who obviously is also at the beginning of the journey, just wants to start. There are some great Excel overviews, particularly for the physical risk part, and also separated for the transition risk part, where you have immediately a great overview about the providers in the market. The next slide, as we know, obviously the financial institutions face various obstacles in using those tools and, picking those tools. So these were a few challenges that have been identified last year. And as we can see here, we have 5 of them listed. And I don't want to read them up for you, but maybe just to pick a few. So the first one is increasing standardization and mainstreaming. So it is really that obviously everyone is having the challenge that the regulations are trying to standardize. Also, the vendors are not regulated yet. So we all are trying, obviously, within the market to line over the coming years and to really integrate the same recommendation across different reporting standards. So we see it already. There is an uptake on the NGFS scenarios, which is why I also heard about yesterday. But I think this is an ongoing challenge, and every one of the climate experts is obviously involved, and we do see some development in the market. Also, maybe to pick the fourth challenge here, so it's the knock-on impacts of climate risk under the asset by existing set of tools, and these are really that some secondary effects of climate change, like the health shocks and migration or physical impacts are not yet adequately modeled within the current version of the modelers. But again, they are also early in the process, and there's obviously right now also no evidence that, for example, the COVID pandemic has something to do with climate change, but this is another field which is quite interested for research and for climate science to look into, and this is why it is listed as one of the other bigger challenges in the market. Then on the next slide, there is the other report. So this is actually the supplement guidance. It is called the Climate Risk Tool Landscape, which was published beginning of this year. And this report actually highlights some piloting exercise and case studies. So based on the vendors that were analyzed in the first report, some banks had the opportunity to actually do a case study with the vendors to test their features, to really run their own portfolios through it. And this report really looked into giving the transparency, what case study have been done, what have been, what was the result out of it, how was the collaboration, but also highlight some of the, I would say, kind of a wish list. What are actually the industry needing? What the vendors have not addressed yet? And I think this is important, and this is why we need these kind of working groups to really continue having the peer exchange and to exchange the knowledge so that vendors and industry comes together to together work on those topics that are required. And because we all are in a very fast changing environment, and this is a market which is going to be changing all the time. This is why we are, again, also this year running this working group and looking into how has this market actually evolved and what has changed. So we do expect to have another report published next year about it to really see what maybe have the vendors already adapted, have the needs been addressed over the last 2 years, and what is maybe also realistically never been in place because the data is just not there yet, for example. And with that, we can come as well to my last slide of this section. These are 7 trends within the marketplace that have been identified. And also just to pick a few of them, the first one is really that we see a lot of merger and acquisitions in the market. Currently, a big of the bigger players, like for example, Moody's are acquiring RMS because they are trying to get their knowledge integrated. So at the end of the day, they can be one vendor that is able to provide a transition risk solution, the same time having the physical risk knowledge. And this was one of the bigger needs from the banks, to have not multiple vendors being partnering up with them, but having one partner at a time that can offer an integrated solution, and which helps them obviously to also trying to get it integrated into their own banking processes. So this is obviously also in line with the second trend that those risk methodology are being combined. And I mean, another growing risk is another growing trend that we have seen is that different transition risk scenarios are really focusing on net zero. The need for net zero scenarios are obviously becoming more important. So we see that the majority of the vendors are integrating 1.5 scenarios to see this as well in comparison to also the more long-term, more disorderly scenarios. And with that, I'm at the end of my section, and I would like to hand over to my colleagues. And again, please feel free to raise any question in the chat so we can, and I also will try to keep up and trying to answer them.
Thank you. Hi, everyone. I'll take next. Good morning, good afternoon, good evening, wherever you are around the world. I might get straight into it because we're running a little bit behind time here. But my name's Evan, I'm with CDP. And in this next section, I'd like to go over what choosing metrics and setting targets looks like for banks implementing the recommendations of the TCFD. So as a reminder, the metrics and targets pillar of the TCFD is that very inner layer of the TCFD. All of the other layers of the TCFD are really underpinned by appropriate and effective metrics and targets that are linked to material climate risks and opportunities that you have identified. And this fourth pillar of the TCFD is really about disclosing the metrics and targets that you're using to assess and manage relevant climate-related risks and opportunities. So let's break down what the sort of three recommended disclosures of this pillar actually are. So firstly, we have sort of metrics, and these are, here we see sort of cross-industry metrics that are important for all organizations to disclose, including transition risks, physical risks, climate-related opportunities, internal carbon prices, and remuneration. And then it's also important to disclose any sort of assumptions or methodologies used for these metrics. And then on that first recommended disclosures for banks in particular, there are three pieces of guidance on metrics. Firstly, that banks report on metrics for lending and financial intermediary business activities. Secondly, that they report on carbon-related assets. And thirdly, that they report on metrics on performance in aligning with a 2-degree or lower scenario. And here really connecting our strategy disclosures with our metrics disclosures. Then that second recommended disclosures really hones in on those greenhouse gas emissions. The TCFD recommendation specifically on greenhouse gas emissions. And here, all companies are recommended to disclose scope 1, scope 2 emissions, and if relevant, scope 3 emissions using the greenhouse gas protocol. And for banks, those scope 3 emissions are going to be highly relevant, as that's where most of the emissions across all 3 scopes for banks are actually located in those scope 3. So in those sort of lending and investment activities. And so specific guidance for banks to report on greenhouse gas emissions for lending and other financial intermediary business activities are recommended to use the PCAF, or Partnership for Carbon Accounting Financials methodology. This is a sort of recommended methodology from the TCFD for this disclosure. And then the last recommended disclosure for this pillar of metrics and targets really focuses on the targets piece. And for this disclosure, all companies should report long-term and interim targets considering absolute and intensity-based greenhouse gas calculations, timeframes, base years, and key performance indicators. And just to clarify, as we sometimes get questions about absolute versus intensity emissions, absolute emissions are those sort of gross overall emissions that an organization has, whereas intensity emissions refer to an organization's emissions relative to some sort of economic output like revenue. And again, here it's really important to report on the methodologies that are being used. So those are the sort of 3 recommended disclosures with this pillar. And here on this next slide, we see progress on all 3 recommended disclosures for metrics on targets year over year. Based on the last fiscal year assessment, the percentage of companies reporting across all 3 metrics recommended disclosures ranged between 40 to 50%. And I'd like to particularly note the drastic increase of the disclosure of climate-related targets, really indicating that companies are really recognizing the importance of setting goals to manage their climate-related risks and opportunities that they're identifying. So with that, I think let's have a look at a couple of examples here. Here we have an example from Standard Bank Group, who has metrics for their climate-related climate within their overall ESG indicators. They have metrics for sectors with elevated transition risk exposures, such as coal-fired power generation and oil and gas. They have metrics for sectors with elevated financial risk, specifically looking at the agriculture sector, which is vulnerable to some both acute and chronic climate risks. And then really importantly, they have started to disclose metrics for opportunities by looking at specifically at opportunities created through climate mitigation in the renewable energy sector. Another example that we have comes from the Bank of China's 2021 CSR report. On the left-hand side of the slide, we have sort of narrative description outlining some of the Bank of China's climate-related metrics and targets. From the diagram, we see the proportion of total credits to brown industries accounting for around 10% of their corporate loans. And this helps us to understand the exposure of the Bank of China's lending to high-risk sectors and how they're performing in managing these risks over time. Next, we have Bank of England's roadmap for reaching net zero. This gives banks and financial institutions more broadly a clear picture of the sort of pace and direction of travel for the UK's financial system. And this pathway and other jurisdictions' pathways can really be used to help inform some of your own interim and long-term targets. Because we're running short on time, I might skip this last example and go directly to a break. So we'll still give you all a break, but please come back
from the short break. Within the next section, we are going to talk about setting the net zero targets. And we are starting off this section with the short video.
The runners are on their marks. We are racing towards net zero. But what are we racing for? And who else is racing alongside us? Carbon dioxide. CO2 makes up 80% of the greenhouse gases that act as a barrier in our atmosphere, trapping heat, causing the temperature on our planet to rise. And when that happens, our systems collapse. Net zero recognizes that we need to reduce our emissions to a point where we are no longer increasing the concentration of greenhouse gases in our atmosphere. But to reach these ambitious goals, companies have to change. Policy has to change.
Great. So this is really an intro video, and I want to highlight here two main things. And the first one is really the net zero. And it's kind of important that we start to define the term, because we are all using it interchangeable in different conversations, which has on their website like a catalog of words they define. Net zero actually means is when the emissions of greenhouse gases in our atmosphere are actually balanced out by the removals over a specific period of time. And what does it mean? It means actually that we can kind of still continue emitting greenhouse gases, but we need to bring it to zero in terms of that we are balancing it out and use removal technology to take it out. So this is why I kind of always want to highlight it. We are talking not about zero, but we're talking about net zero. And the second point is the Paris Agreement goal is obviously to limit global warming to well below 2 above pre-industrial levels, and to pursue really any effort to a 1.5 scenario or to 1.5 degrees temperature. And this is really in line with the latest climate science. And we always get asked, but why is it 1.5? And the question is it, or does it make really a big difference if we are talking about a 0.5 increase and we're ending up with a 2 degrees scenario? And the current 1.5 of global warming is already having impacts and causing really damages, including in form of extreme and danger weather events. And I mean, we all saw it this year with the global heat waves. We had expensive wildfires, we had deadly hurricanes. And this is actually really which is urging us to adapt and build resilience. And this is only becoming more pressuring in a higher temperature world. And just to quantify it a bit more, so we already know, and all of us know, that higher temperatures actually lead to higher or greater climate impacts on land, the ocean, in the polar regions, anywhere. But over time, what we can do better now is really to quantify those impacts. And just to give you an example, 700 million people, which is equally to 9% of the world population, will be exposed to extreme heat waves at least once every 20 years in a 1.5 temperature world. But more than 2 billion people, which is equally to 28.2% in a 2% world. And very similar, another example is in a 1.5 temperature world, the end of the century project is that 70% of our tropical coral reefs are at risk of really severe degradation due to the temperature, including, the bleaching. But virtually all will be gone if we are talking about a world which we have a 2 degrees increase. So this is just giving you some numbers to show you how the impacts are shifting if we are talking about 1.5 world or in a world where we have a 2 degrees. Before we're going into more detail on that slide, I wanted to mention the GFANZ, the Glasgow Financial Alliance for Net Zero. They're a global coalition of leading financial institute recommendation section, and it should be obviously in line with the overall strategy the business or the organization is currently having or also communicated. And in general, the targets should be quantifiable, they should be measured. And this is why I was highlighting the baseline again, to actually trace your progress you are currently doing. And they need to be clearly specified over a different time horizon. And this is why we also have the picture on the right side. It's always good to put the interim targets. They are as equally important as to come up with the pledge. And OmniMaker really shows the relationship between GHG emissions and the targets for a hypothetical firm. So it really illustrates the difference. We are going to the next slide. Generally, we are always talking about 3 main methods of target setting that you can distinguish. And I know, again, it's a lot of text, it's a lot of theory, but I do have some other examples at the end of this section where we are actually looking into some practices where we can see disclosures that are already publicly available. So the first metrics is the absolute emissions, and absolute finance emissions means really critical as it requires to drive down the emissions in a specific sector. And as I mentioned, it is mostly used for also the oil and gas because it's required to actually speed up and accelerate this process. So this method really allows to the aggregation across different sectors. However, the challenge on the other side with this metrics is it is harder to compare, obviously, with different clients and then different sizes because we are just talking about the absolute terms. The second metrics is the emissions intensity. So this is really the volume of emissions per unit of GDP. So reducing emissions intensity means really less pollution is being created per unit of GDP. So while here in comparison, this metrics really allows companies across different sizes to be compared. However, if we are now looking into the next slide, so this is the first out of 2 examples from this deck, what we brought. You can see this is the Citibank net zero target setting example, which they published. And again, here you can see on the bottom left that we also linked to sources. On the top, they are highlighting their 5 main steps, how they actually took to put a net zero target. And they really started in calculating their emissions. And from there, they really identified appropriate scenarios that they wanted to put in place, that they were really aligned with their own transition. And they established their reduction targets with, again, also as an example we saw before for 2030 and beyond. And from there, they started talking about their implementation strategy. So what do they need to change with their clients, with the community, with their suppliers, and how do they actually want to engage with different stakeholders in the markets to have a successful transition. In the bottom of this page, what you can see here is they actually published also their net zero targets for 2 different sectors. So what you can see, they have and this is something we very commonly see because obviously energy and power are the sectors where we do have the majority of data available. So for energy, they publish scope 1, 2, and 3. And what you can see, they put here a baseline year of 2020. And they put in absolute terms, the 143.8 million CO2. And just also because of being very transparent, they published the climate scenario that they are currently using and also the interims target in absolute terms, what they actually want to decrease. And this is what you can see under the 2030 targets. So the same you see with the power. They actually fulfill.
Leah, I think you've gone on mute. Oh, there we go.
It's showing what is the transition plan, and then we'll try and have a digitalized discussion. There are 7 points to a transition plan, which is illustrated on this slide. The transition plan should be part of and aligned with the financial institution or the institutions. Also, the transition plan should contain sufficient information to enable users to assess its credibility. For example, the plan should describe the current climate capabilities, the transition pathway, and the financial plan. The institution may also want to describe significant limitations or constraints and uncertainties in the transition plan, For instance, challenges regarding estimating Scope 3 emissions. Thirdly, a transition plan should articulate specific initiatives and actions that the institution will undertake to effectively execute the plan into play. Fourthly, the transition plan should be designed to consider and help achieve specific targets in the FI's planned transition to a low carbon economy. Progress against set targets should be regularly tracked using appropriate metrics. The transition plan should be consistent with the broader 5 years and updated as necessary. The financial institution should review its transition plan in line with its review process for its climate-related targets in order to ensure continued relevancy and efficacy of its overall strategy planning process. And it might be that they will need to update their ambitions of their transition plan as they move on. The financial institution should also report public on its transition annually, including significant updates to the plan and a comparison of completed actions to what they have actually originally envisioned that they would do. Finally, their plan should, or the institution should probably describe what's the approval process and the oversight and the accountability responsibilities within the institution, including the role of the board and the senior management in overseeing the transition plan. Next slide is an example of the Dutch asset management firm Robeco's roadmap or transition plan. It shows the decarbonization pathway and it lists the measures to be taken for each of the 5-year period from 2015 to 2030. Baseline for their calculation or estimations are set for 2019 and the net zero target is 2050. The commitments are to reduce emissions from their investment portfolio and operation by 30, 25% respectively by 2025 and by 50% by 2030. The distinction between emissions from the investment portfolio and the operation illustrates my point from previous slide that emissions from investment portfolio, i.e. the Scope 3 is much higher for financial institutions than the operation is. And it's also where it becomes more difficult to lower the emissions. It requires a different approach, such as, for instance, investing in climate funds, which will tilt the overall portfolio, and engagement in investee companies helping these to transition. The plan also lists 6 areas of actions in the lower left corner. The financial system plays a vital role in facilitating the allocation of capital throughout the economy. Financial institutions support the real economy by allocating capital, which provides the related service to firms to enable their business activities as well as finance for forward-looking strategies. DFANS believes that financial institutions should redirect capital to encourage ambitions and credible net zero strategies and emission reductions by their client and portfolio companies. And this is actually what we see illustrated in the next slide, where DFANS framework for the elements of a transition plan for financial institutions is outlined. You will see at the top that there is a bank-wide net zero commitment with targets, timelines, and priorities, which is translated into 2 different pillars: the implementation strategy, which will align business activities with the net zero target, and the engagement strategy, working with clients, peers, and the broader society and governments to support the real economy transition. It will also require metrics and targets to assess and monitor the progress, and it will require good governance with clear roles, responsibilities, and oversight, just as we saw described under the TCFD. Moving on to the next slide, this is different areas of activities or engagement implementation as outlined by a recent report by DFANS. It actually describes 4 approaches that can be used by financial institution or investee company, asset management company, investment companies. The easy one is to increase business activities with companies that provide climate solution, thereby they actually tilting the overall portfolio towards climate solutions. But another one would also be to reward companies that are aligned with the 1.5 degree, i.e. with the Paris Agreement, and enable that activity through, for instance, cheaper funding. Where it becomes a little more complicated is when we start talking about the high emitting clients. And here the bank can help these companies to develop and finance their transition strategy and plan. There may also be a need to phase out of high emitting assets, maybe even divest for certain companies. And this can be because there isn't a reluctance with the client to do it. But it can also be that there are just assets that eventually will strand, but needs to phase out of the economy. Page 12 of the report has more details on these 4 different approaches. That brings us to the last slide, and it's now time for you to act. You will be able to, through the QR code, to access the Menti, which will raise some questions about how do you see in the short, medium, and long term, where should you put in your efforts to develop a transition and move your own business towards a more low carbon economy. So over to you. I will give you a minute to answer the first question, and we'll see how well it goes. You already see a good activity, and then the different pillars are moving back and forth. I see that. So this is the strategy mix best suited for the organization when considering a long-term time horizon. And the biggest one seems to be expansion of financing climate solution, carbon removals, i.e. tilting your portfolio. Second come financing and transition of high emitting clients and engagement with high emitting clients. So since this is the long-term view, there definitely is a need to engage with clients and help financing in this period, because you want to have high emitting clients on track by 2040, because they need to actually hit net zero by 2050. So definitely this is the area. We can discuss whether there will still be a lot of activity to do in the climate solutions space, because ideally, we should already have implemented all the climate solutions that are available, but to some extent, there will be an overlap with what happened in the transition of high emitting clients, because also there you need to implement climate solutions. Divestment from high emitting clients seems to be the lowest. And that there can be a lot of reasons for that. That can be the reason that you want to wait to the very last minute to divest. But the longer you wait, the higher is also the risk that you actually will have a stranded asset. So that's one of the things you need to consider if you are hesitant at divesting. But let's move to the next question and see what the distribution is here.
Sorry, Berit, I think I started with the last one. So we're going to move to the front now and they can look at short term.
I thought we were starting with a long perspective. But sorry, everyone. Let's
we pushed them to the long distance first. Now we can bring them closer in.
Somehow already revealed some of the answers, right? But let's see what are the solutions, or what are the things we can do right now in the short term within basically the next 3 years. Okay, so in the very short term, I would tend to agree with what seems to be also the outcome here, expansion of financing climate solutions. You should not delay in engagement with high emitting clients, because getting them, first of all, to recognize the need for them to transition, and next get them to commit to it, could be a cumbersome journey. So get started on that journey sooner rather than later. Divesting for high emitting clients is perhaps not that important, but again, keep in mind that the flip side of this could be stranded assets, where you sit with an asset that has a value of 0 in the market. So you basically lose money on that. Financing of the transition of high emitting clients go well with the engagement of it. It's a question of whether they will ever be ready in the short term. Some are already moving in that direction, and they're definitely ready. So this is a space that is just opening up for what we call transition finance, where the client have a plan and a strategy and an investment outlay for how they intend to transition. Let's see if we could get the medium term up and running. So while we are voting on this one, I see there is a question from the audience saying, why to divest if the high emitter has its own decarbonization strategy? So this really comes down to where is the client? Because when we are talking about transition finance, in order for it to be credible, there needs to be a commitment and a strategy from the company. And it needs to be following a science-based decarbonization pathway with clear targets and goals and a strong governance internally to actually get it rolled out. There you will also typically have an investment plan where you can see what needs to be invested in when. The challenge is here that as of today, there are industries which we are still in need of, but we don't know how to get to net zero. And there may come a time where we either find a solution, and that's fine. There may also come a time where we realize we just have to leave that industry. And on the flip side is also how long can you wait before you actually end up with a stranded asset. Okay, let's see what is in the medium term, and this is actually in the decade of until 2030, which is coined the important decade. It's really this decade we need to see action. Again, it's the climate solutions that come out as the important one. And yes, that is the low-hanging fruit. And this is not to be understood negatively. It is absolutely an important part of the transition, but it cannot stand alone, and definitely not in this decade. In this decade, we need to really scale up and get high-emitting clients on track. They need to have a transition plan by 2030, I would say, in order for us to meet the goals of the Paris Agreement. So that cannot be pushed on for much longer. And part of that, getting them on a trajectory, get them started on the decarbonization, is also being able to finance that path. So with that, I think I will wrap up, unless there is actually a question here. Is there a concise, widely accepted definition of stranded assets? Good question. No, I don't think so. I think you can get a more theoretically definitions, but if you by a definition mean that you actually can get a list of what will or are stranding. So the answer is no, because this is the challenging part of climate change, that we really don't know how a number of industries will change and strand. It's the disruption of the climate change. I hope that answered the question. Otherwise, I will hand over now. Thank you.
Great. Thanks so much, Barrett, for that. I think that exercise is so helpful to get people to start thinking about what we need to do, not only today, but moving into the future. And maybe that builds a bit on what we were looking at yesterday too, where we saw that the actions we take now can have a significant impact in the future. And with climate change, we have to look a little bit more through those time horizons. So that brings us to the end of our full training session today. However, we don't want to leave you just with that content. Of course, we want to fill your toolbox again before we move on today. So a few key publications and resources that you can use as you continue on this journey. And do remember, it's a journey. I'll keep reminding everyone, it's usually about 3 to 5 years for alignment. And then even when you're aligned, you know, the data keeps improving, and we keep getting better scenario analysis and better science that we can use to improve our risk analysis and our risk management. So it indeed is a journey. TCFD itself has a number of publications, and it keeps coming out with more. So don't forget the TCFD website on fsb-tcfd.org. You can find all their publications there. You can also get a workshop in the box where you can go through a lot of this detail as well. I point out particularly on this slide, you can see 2021 implementing guidance and also the 2021 guidance on metrics, targets, and transition plans. This is really helpful when you're starting to do that analysis of how does this have a financial impact on your organization. The TCFD has gone through a lot of effort to illustrate how these risks and opportunities financially impact organizations. So that's a great starting point when you're getting started. Another really great resource is additional training. So you can do that through our SSE, IFC, CDP training. The links there. You can also get a lot of training on the TCFD Knowledge Hub. You can also get that training on the TCFD Knowledge Hub with a CPD certificate as well. So here's an example of some of the different courses you can get. I believe there's even some in Portuguese and a couple other languages. I mean, maybe Chinese and Portuguese, I think, are the options there. But please do make use of that as well. They have both introductory lessons as well as more detailed, such as TCFD for accountants and water accounting, and going into more detail with that. Okay, and a few more resources based on the topics that we cover today. The first one is from Ambition to Reality: 5 Ways Corporate Banks Can Live Up to the Net Zero Commitments. The second one is on financial institutions and net zero transition plans. The third, guidelines for climate target setting for banks. And the fourth on measuring portfolio alignment. So these can all help you as you start to move through that roadmap that you're going through with TCFD and your alignment. And as part of that process of aligning with the TCFD's recommendations, you'll start to introduce scenario plans, targets such as net zero targets, and transition plans. So you can use these resources as you move forward with that. Also, just to highlight, if you would like to get your CPD certificate, we just ask that you fill in a short survey. You can't, of course, click that link on your screen because we're just sharing screen here, but you will get that link in your chat box, and you can then fill out that form. You will need to have participated in 2 sessions, so a part 1 and a part 2 session. And then once you fill in that survey and we verify that you've participated in both sessions, we then send your details to CPD, and they will send you a certificate. They've let us know they have a bit of a backlog, so you can expect that within about a month. And with that, we have time for questions. So anybody who would like to ask a question, I just ask that you raise your hand. And when we see your hand raised, we can let you go ahead and ask your question. Okay, we have 1, 2, so maybe Martin, you are allowed to talk if you want to ask your question, and maybe let us know who you want to direct that question towards too, because we have all our experts here on the call.
Yes, can you hear me, Tiffany?
I hear you great. Go ahead.
Yes, our nice presentation, by the way. Thank you so much. I just want to know, for somebody who missed the presentation yesterday and attend to the presentation, will they still get the certificates?
Unfortunately not. We can only provide the certificate if you participated in both. If you'd like to see the presentation yesterday, you can catch that on our YouTube channel. So Vanina will put that in the chat box so that you can catch it. And then if you also want to follow our social media or on our newsletter, Vanina can share that too. We can let you know when we hold additional training sessions, and then you can hopefully participate in both. We appreciate that a lot of people wanted to join this training, much more than we were expecting, and we had to cap it at 500. So we appreciate it wasn't your fault that you could not join. So we'd love to have you in a future one. And if you do want to join any other CPD certified training, I suggest going to the TCFD Knowledge Hub in the meantime, where you can get up to date on your training that way as well. We have another question. You're welcome. Thanks for joining us, Martin. We have another question here. Vanina, did you see which one was first? Okay, Guillaume, I believe you can speak now.
Hello, can you hear me?
I can hear you great. Go ahead.
Thank you very much. Yeah, maybe this one is a little tricky. I put it on the Q&A, but didn't get an answer.
Oh.
So for financial institutions, scope 3 emissions are financed emissions. So I fully understand, and when you do a loan to a corporate company, obviously you can compute those as financed emissions. But what about interbank credit? Because if I account for a piece of the emissions of my counterparty, they themselves have given loans to other credit entities, etc., etc. So it's like of a never-ending loop, if you see what I mean. So does that make sense to account for interbank loans?
Yeah, I'm gonna see if our colleagues at UNEP-FI have an answer to this one, because they work with banks all the time on that.
Thank you.
Absolutely, and I think David is also on the line, so I think he wants to take this question.
Sure. Yeah. Thanks,
Great.
Guillaume. It's a really good question, and I think a challenging one, because when it comes to different types of financing, we have work that's being done by the Partnership on Carbon Accounting Financials, looking at different asset classes. So whether you're making a corporate loan versus investing in real estate versus raising money in the capital markets. So at present, approaches to interbank lending haven't yet been fully captured in terms of what what that total share of emissions would be. But yeah, there's definitely a risk of double counting. What I would say is it's about responsibility more than aggregating up. The success of the emissions accounting regime is not that we count all of the emissions overall, because we know how to get to that number. There are many sophisticated assessments going on. If you're interested in that, the Global Carbon Project is probably the best compendium of that. But the idea is that each company or each financial sector participant has a role to play in decarbonization. And so just because your scope 3 emissions may be someone else's scope 1 emissions doesn't mean that you can wash your hands of them. And so I definitely appreciate that point about the duplication. And in some cases, when it comes to claiming overall reductions, I think what your concern is well-founded. But when it comes to how a firm itself sets its path to decarbonization, I think we're still working on the mechanics of what that approach would look like. So how would you apportion it? But it would fit into, interbank lending would fit into the scope 3 of financed emissions.
Great. Thanks so much, David, for picking that up. And I hope that Guillaume answered your question. I'd also like to offer Munir an opportunity to talk. You have now been unmuted.
Thank you very much. Actually, thank you very much for this training. My question is just to have an idea on the way forward. I mean, we followed with very interest this 4 hours yesterday and today. And yesterday, when you kind of asked at what levels we are, I think there is probably still a need to have a hands-on practical things and exercise and so on. So my question is there any second phase or modules that are more in detail and exercises to kind of get more capacity on this? Thank you.
Great. Thanks so much for that. First of all, it's great to hear that this was useful, and we indeed want to make sure that we continue to help you through this. So in addition to us providing additional versions of this particular training, there's also, as I mentioned, the TCFD Knowledge Hub, which you can make use of. And please keep in mind that in your local countries, the IFC also provides a lot of bespoke support and training. So there is an email address you can reach out to in the chat. Maybe Carlos, you can drop that in again, the Green Banking Academy. And then UNEP-FI has a lot of training. So do you guys want to talk a little bit about what you guys can offer on that side?
Yeah, absolutely. So on the training side, there are a number of offerings that we have at UNEP-FI. Specifically, there is an online interactive course over a 3-week period looking at the TCFD and climate change. We also have just launched our PRB Academy, which is for banks to explore both climate and sustainability issues. And also through our climate risk and TCFD programs that I oversee, we bring in specific guidance and development around disclosure, assessment, and measurement. So a number of ways to engage with us. You can see on our webpage, unepfi.org. And as I said, kind of throwing it back to Tiffany and IFC and others, there's a number of really terrific trainings out here. And the goal is to build skills through engagement with many of them. So we'd be delighted to see you in future sessions and future manners of engagement too.
Great, thanks so much. And that actually brings us to the very end. We have just 1 minute left. And with that minute, I'd really like to thank all our partners. It's been a pleasure collaborating with all of you. And I think, as David just mentioned, it's really important that we have this interaction and that we share this knowledge collectively. So we look forward to future trainings together. Just as a reminder, this training is brought to you from the IFC, from the UN SSE Initiative, from the UN Environment Program's Finance Initiative, and from CDP. And you have all of our contact details here. We also like to thank all of the sponsors that supported this on everyone's behalf. Thanks so much, everyone. I hope you have a really great day, and we look forward to seeing you in future trainings.